there's no reason to have a banking crisis ever. There is no, natural boom bust cycle that we have to follow, like it's a law of nature or something. I've heard this a lot before I got any sort of exposure to MMT, that yes, we have found out that when you sign the loan documents, you have just created a promissory note that the bank purchases from you. And then that's what they're able to trade around. And usually in the circles that I heard about it before, that they were all up in arms like, oh my God, you didn't actually lend me any money. This is horrible. I'm going to sue you. Whatever. That was the attitude, as opposed to what I think should be the proper attitude of like, okay, this is just how this thing functions. Money gets created through this method. Now, Werner says on the video, well, which one is it? And he said, I decided to empirically test this. Which is to say, he wanted to find a bank where he said, I want to come and take out a loan, and I want to see exactly what's going on in your inner system to figure that out. And it took him a while to figure that out to find a bank, because no bank wanted to show them their inner system. He said he found a local bank in Germany at some point that lent him 2,000 euros, and when they looked at how the numbers moved, no money moved from any account anywhere.
I think it was 200,000 euros, if I remember correctly. But
I thought that's what I said. What did I say? 2,000?
I thought you said 2,000.
Okay, yeah. That's right. It was 200,000. He gets, in quotes, loaned 200,000 euros, and then he moves it to another bank, his bank. And in that process, no money from any other account in the bank moved anywhere, conclusively proving that the money creation theory is true.
Yeah, I mean, he basically had them really give him snapshots of what happens to the individual accounts in what moment. And yeah, that's what he walked away with. The bank created the money out of nowhere. And when you transfer the money to another bank, then obviously that bank is going to request reserves from this bank. The reserves move over. And that's it.
Mm-hmm. So what do we extrapolate from this? We're going to extrapolate a lot. But the first thing that hit me is, again, simply identifying that there have been three different interpretations. Because when I've gotten information, depending on the source it comes from, nothing makes any sense, because oftentimes the information is conflicting. And I think particularly from people who have, say, that they've decided that the Federal Reserve is a private bank that's super evil, that that we have to borrow money from, and so on and so forth. I'm guessing, I'm theorizing here, that they've actually gone backwards in time and looked at the literature and looked at the understanding back in time, and they're picking from that era, not realizing that there's three distinct eras to pick from, right? So if you're not aware that these three distinct eras of understanding and theory to pick from, and you're just picking these three different theories, which are completely contradictory to each other, then you're just going to end up with a mess. And on top of that, the fact that Werner does do this empirical test, he figures out that it's theory number 3, which is the money creation theory. Because the money creation theory is contradictory to the other two, what that also means is that economics, unless it's pointing at the money creation theory, it's just like voodoo. It's just total made up nonsense. At least, talking about the banking system for this specific case right here. So if economics is total voodoo made up nonsense, what would you expect? You would expect 100 banking crises in the last 50 years, right?
Yeah, they're basically, it's voodoo, but they're stabbing in the dark,
Right. So he makes a very, very interesting point, and multiple points. The first is, and this isn't news to me, but I'm going to reiterate it here, is that the banking system creates about 97% of the actual money in our system. 3% comes from the government, 97% comes from the in quotes, private banking system. And if we recognize that money is created when loans are made, what this means is that this is a really, really, really important aspect of our entire society, is how this banking system works and what they direct the flows of money towards. Because if they're just intermediaries, if they're just middlemen, then that doesn't matter that much, right? If they're the actual money creation system within the society, then what they create the money for is going to very heavily influence what that society ends up doing economically, right?
Yeah. Yeah, they're basically shapers of the entire economy. They are the masters of the economy, if you will. They decide who gets spending power and who doesn't. And then what that spending has to be directed to, if it's a business loan or whatever. And then also that nowadays they make consumer loans and all those things. So yeah, their role is of primordial importance within the entire Western, probably the whole world's economic money system.
Yeah. And he does emphasize, and we definitely want to get him on to talk about stuff like this, that there are central banks actually have a bit more power than I thought they did, coming from the MMT perspective, but they have a different type of power than I thought they did. And I don't want to get into that right now because I don't remember it enough off the top of my head to talk about it. But I bring that up because the thing that we're talking about right now actually isn't influenced by the central bank. Where the individual banks on the ground are choosing to throw their credit is not something that the central bank necessarily cares about, right?
Well, the central bank can make regulations in terms of which loans are to be made, or some regulatory agency can make them. They just happen to sort of, for the past decades or so, they haven't really done that. They've stepped back from it.
And they focused on interest rates.
Rate manipulation, exactly.
Which we could talk about later. The point I wanted to make is that 2 points. If we understand this, that, okay, the banking, the bank, that one right there down the street, has power to direct flows, obviously within the scope of regulation. It's not the central bank going, okay, I'm gonna throw my weight over here or throw my weight over there. They do have power to do that in some aspects, but not specifically in the one we're talking about right now. It's these individual banks. What's that?
Also, what he's saying is they do want to have more of that power, and they are on the path towards that by messing with the whole banking system.
Right.
And then central bank digital currencies, that kind of stuff. They may be on the path towards that, but it doesn't have to be that way.
Right. And we need to understand it first, because the reason we keep getting these banking crises, according to him, is that loans, again, and we shouldn't even use the word loans, money creation, a large amount of money creation gets directed toward financial transactions versus productive investment. What were you going to say?
Yeah. Well, I just want to sort of lay out the big picture of the regulatory response.
Good point.
So the theories of bank's an intermediary, or the bank is a fractional reserve bank. These have all led regulators to come up with things like minimum reserve requirements and capital requirements. So Basel, for example, says the bank has to, part of Basel, if I understand correctly, has to have so and so much equity and so and so much reserves. But neither of these approaches
addresses anything.
Well, if you're familiar with balance sheets, they address the liability side of the bank's balance sheets. Where does their funding come from? But it doesn't address the asset side of the balance sheet, which is what kind of loans do they actually make? That is really the only thing that that matters in terms of banking. Is what kind of loans do they make? It theoretically would even be conceivable, I think, maybe I'm wrong, but you could have a bank without equity, only
loans,
only loan funding, only deposits funding. If they make good loans, then obviously, from the standpoint of profitability, wanting to make a profit, all that, then you have just some equity so that the owners make some profit off of that. But technically speaking, it's not required for the bank to be sound. What's much, much more important, and it's such a dumb moment, it's such a, obvious thing. Obviously, it's what kind of loans do they make?
Are they making good loans?
Yeah. So what you were saying is he's suggesting that the big problem over the past decades has been that banks have made loans to facilitate financial transactions, such as real estate purchases,
or hedge fund speculation,
or margin lending for hedge funds. All these kinds of things that, if anything, they facilitate a rally in the price of certain assets, financial assets, but they don't create any value, such as, for example, a productive loan. Like a bakery wants to have a bigger oven, and they take on a loan, and then they make more bread, and then they make more money, and they can pay off the loan.
And they can hire more people, and they can, yes.
Now the economy is richer in actual measurable people, like in terms of that we
goods
the
and
people,
services, yes.
Goods and services, yeah. So the more lending goes into these financial transactions, the more it'll be inflationary. He also pointed that out. But
hold on, before you get off from that, I think that's huge because inflation is such a big topic, right? And in terms of our generation, because we all know our generation and the Zoomers, you and I are millennials, and the Zoomers, Generation Z, we've got this bitter fight between us and the boomers because the boomers inherited a completely different economic system than we did, and they it's irritating what we hear from the boomers, but at the same time I don't think that the millennial vicious response is helping anything. Because I think if we want to say, okay, well, a boomer back in 1959 or 1963 could get a job out of high school and buy a home and raise a family and have savings and all that sort of stuff, and that's just completely out the goddamn window now because a starter home's $500,000, right? And I mean, I'm not saying that that's not true, but I'm saying is I suddenly have a very clear understanding why, at least from and I don't want to say that this is entirely a banking thing, but from the banking thing, if money creation is being aimed at these financial transactions where you're not creating anything new, by necessity they're inflating everything, well, of course the price of housing is going to go up, right? As opposed to if we go toward productive stuff, which is say, where's a productive business that we can create this money for? Well, then the money creation would be aimed more at the productive businesses, less at the real estate. The real estate could either come down or at least stay stable, and that people could make more money. Let me turn my camera off. People can make more money because there was more stuff invested into production. So, yeah, inflation is just what I wanted to address, and that if currently the banking system or the banking theory doesn't really differentiate between what type of loan is being made and therefore doesn't regulate it, and Werner points out that this is really a question of regulation. If the regulation came down and said, okay, stop, doing all this speculative money creation for financial transactions, which will lead to a bubble. He does point this out, right? Because if you're just funding financial transactions and there's no real growth that happens behind it, the only way that game continues is as long as the bank continues to pay create money for future financial transactions, which leads us into the situation that I've described a million times from the MMT perspective. That can only keep up as long as the government is keeping up enough deficit to fund the system, right?
Yeah.
Because the private sector can only go into debt so much with itself.
He singles out, at the present, he says the ECB has been particularly egregious in terms of facilitating financial speculation in Europe. They did that in Germany. I think the interview was in 1918. He said, check me out in 4 years. There's going to be a big bust.
You mean 2018?
2018. Yeah,
He
sorry.
said 1918. I was very confused, but I figured it out. The interview took place in 2018. That's what he even meant to say. Yes, go ahead.
And, right, he says that they're blowing up a bubble in Germany right now, and it's gonna probably bust in about 4 to 5 years. So this is where we are now. Real estate prices have soared incredibly in Germany. I was just there, but they've stopped rising. They are coming down now. It's not necessarily a bust yet, but now you're seeing, you know, all these economic issues.
Did the interest rates go up in Europe as well?
But they just started going up, but not as in the US yet. But they just started for the first time in 11 years or so. I think they started raising rates at the ECB. Yeah, so that's probably also playing a bit of a role in terms of property prices.
Well, and then I do want to emphasize this, and we've talked about this in private conversations several times. When it comes to housing, particularly on a 30-year loan, most people aren't actually buying it on the price, they're buying it on what they can afford with their monthly payment. So if you look at the amortized loan, as you increase the interest rate, the payment goes up. So if you need to keep the payment the same and the interest rate goes up, well, then the price has to come down. And nominally, it looks like the price went down, but in terms of the actual money coming out of your pocket, it didn't change. If you want to figure out that math, go play with a mortgage calculator and you'll figure it out. But I did want to emphasize that, yes, they're coming down, kind of.
Yeah.
I totally interrupted you because you're moving on to the next point to talk about inflation. Do you remember what the next point was?
You mean what the next point was about?
You mentioned inflation when we were talking about productive money creation versus financial, and then you're about to move on to the next thing, and I stopped you.
Oh, I don't know.
Okay.
I thought I was just talking about how encouraging the lending for financial transactions and for speculation, margin lending, property, real estate, etc., doesn't add to the productive capacity of the economy. So yeah, that's inflationary type of lending. But he also goes into later on how you can have lending without inflation, which obviously if you lend for productive purposes.
Well, and then
the amount of goods and services keeps up with the increase in the money supply in the economy.
And he makes an interesting point, I think, jumping from this part of the conversation, is that there's no reason to have a banking crisis ever. There is no natural boom bust cycle that we have to follow, like it's a law of nature or something. These banking crises are a result of us. Well, maybe the people in charge do understand and they're just willfully ignoring it. But whatever the case is, it's us not using the system correctly. I mean, if you have a gun and you keep shooting yourself in the foot and you make the determination, well, all guns do is shoot you in the foot. Well, you're not using it very well. If everybody who's watching this now or recording could like, share, and subscribe it helps us out a lot.
Yeah.
I hate saying it, but it's just true.